Physics of Bitcoin show. That is since some time Scientific Bitcoin Institute activity. It's we are sponsored by the institute. We are introducing the idea of the institute little by little. This is which episode? 39.
39.
I cannot believe it. We did 39 shows, Stephen. It's crazy. And so the Scientific Bitcoin Institute, we have actually, please sign up. We have a YouTube channel. I'm probably going to put some information in the description of the video when we're done, so you can find it. But you can also Google it. We are going to have a website. We are going to have an X account, a YouTube account. We're discussing with Stephen even a Discord channel where you can join, because it's going to be mostly an academic type of activity, but we are going to be open to the public and be working with the public, being transparent, answer your questions, as much as we can. But the main goal is to bring together scientists and scholars and students, but even the public, because if somebody does a study about Bitcoin that is scientifically validated, we are not going to keep them out, simply saying, "Oh, you don't have a PhD, or you are not somebody that works for the academic world." But there will be some vetting. That is the main thing. We are going to work together. Our work included, because that is the main point. We want pushback from reasonable, because sometimes some part of academia or even the financial work is not accepting Bitcoin, as a serious field of studies. But that is the point, right? We want to know why, what are their objections, we want to address them. So we want to validate the idea that Bitcoin is not just an asset, but it's an entire field of study. It's an experiment that we are doing, because we are coming together as humanity, and we want to create something that is not controlled by the government, is not controlled by a corporation, and we want to assign value. And if you really think about the main proposition, it's one of the most fascinating, amazing experiments, independently from the monetary value. And it's amazing that it does have a monetary value. In fact, it's very valuable. And that is actually an attestation that when you do things from the bottom up and you let the laws of nature organize themselves, when you are on the right path, right? And so that is our entire proposition. We have a manifesto that you will be able to read when the website is fully operational. I read it so many times. It's so beautiful. You can see it in the entire idea behind Bitcoin. And people can say, well, Bitcoin is not any longer like that. We betray some of the ideals. I don't agree. I think actually Bitcoin is still Bitcoin, and it's dealing with all these challenges, like scaling up to incorporate the institutional financial world. And yes, there are some compromises that sometimes we need to do, but Bitcoin has kept its nature. That is the main idea beyond scaling variance. It's the same system. It's the same system. If you go deep and you're trying to understand the ideas that we are trying to share with you, it's not changed. Bitcoin is the same. It's doing the same thing that it was doing when it was something that you could buy a pizza with thousands of Bitcoins. The nature of Bitcoin has not changed. Do you want to add anything else, Stephen, to all this? Stephen, can you hear me?
Yes.
Yeah.
Yes.
Do you want to add anything to what you just said?
It's a system that is self-defining. We have this concept of autopoiesis that was developed originally for cells. You as human beings are autopoietic in nature. The sun is autopoietic in nature, and that means it takes in energy and other resources from the environment. But internally, there's a great deal of self-control, self-definition, creation and management. And the cells manage their interior. They take in resources from the outside the cell wall, but then they use DNA, RNA, messenger RNA to build proteins and manage all the interior and all the construction. And there's a lot of homeostasis and self-management. The sun, the fusion in the core is the same way. Humans are the same way. We're very homeostatic, in our operation, our metabolism. And Bitcoin is like that. It's self-managing, self-correcting, and self-creating. And it's because of that nature, ultimately, that you manifest the scale invariance, and then the scale invariance is expressed as a power law. So it's intrinsic to what's a network plus a meta network around the ecosystem. And there's a lot to explore. And that's why it needs, scientific eyes on it and principles of scientific research devoted to it. And that's why, Giovanni had the idea of setting up the Scientific Bitcoin Institute. And I'm thrilled that he asked me to join.
Very good. Okay, and if you have any questions about the Institute, about its mission and so on, first of all, the website would be, the main portal for all these kind of things. But during the episodes, you can also ask and tell us your opinion and so on. As soon as we will also open membership where you can say, I am a member of a Scientific Bitcoin Institute, because you will be supporting it. Most of our sponsor will be corporate. We already raise funds, and we have a different institution or corporations that are interested in helping us, but we want to involve also the public, as I say before. And so there will be opportunity to participate. We will send a newsletter. We will have maybe a pin that you can go around, say, and could be a conversation starter with somebody, to orange pill them or whatever, So we will let you know when this program will start. Okay, then we can dive in the topics we want to discuss. And I ask.
Should I go first?
Yeah, go first, like is tradition. So you start first, Stephen.
Okay. As Giovanni said, this is number 39. We missed a few weeks due to some very important that Giovanni undertook in Europe, but that's what has allowed us to get the Scientific Bitcoin Institute up and running. It's 11th in the US, North America. It's March 12th where I am in Asia. And, we do this weekly, Wednesday, 7 p.m. Pacific time, which is now Pacific Daylight Time. And you see the 20 million, the big news this week, beyond all the buying that Saylor has been doing, is that we reached the 20 million goal for the number of Bitcoin that have been minted. It means there's less than 5% left to ever be minted. And of that 5%, 2.5% will be minted in the next 4 years. So people are running out of time to get their hands on Bitcoin. Here's the agenda. I'm going to talk about, it's a continuation of what I talked about last week, about a model that combines the power law as the structural spine and then puts wave or bubble activity on top of that with a log periodic nature. And I end up using two modes for this particular model. 2 log periodic modes. So I'll revisit the procedure that I discussed in some detail last week. And what I do is I treat residuals in 2 stages. So I'll go through that. The first stage is you fit the power law, you get your first stage residuals. Then you fit the log periodic. And then you get a second stage. And I'll show you all the parameters for the best fits for these. And then I bookend the thing with 2 models because I've got 2 modes. And so I treat the decay, and there is amplitude decay, certainly on the fundamental, the main mode. But I treat the decay of amplitude differently to have a conservative model and a more aggressive model. And the result is that by the end of the decade, meaning January 1st, 2030, on trend, you'd expect 700K to 800K. Now that's an enhanced trend over and above what the power law gives you, because the log periodic modes are quite supportive for the next 4 years. And then I'm going to have a section on the Kelly criterion for a 2-asset portfolio where you have Bitcoin plus STRC, because STRC has been raising a lot of funds. It's been performing well. You know, it's trading just above 100, so it's actually trading slightly above par, and this has allowed Saylor to keep going back to the well and raising more money through this vehicle, and then, of course, buying more Bitcoin. And there are a couple of different ways to look at the Kelly criterion: the original gambler's formula and something that's called continuous Kelly. So I'm going to look at both of those. I did show this last week, but it's a reminder that we're looking at the layers of an onion, but we're not peeling back from the outside. We're starting from the inside and then looking at the layers around. So the core of it, the long-term continuous scale invariance, is the power law core. That's just age to some power, something like 5.87 if you do a quantile regression. And quantile regression helps us to kind of flatten out the effects of the bubbles on the first cut. So we chose that. And with a 5.87 power law, it basically says that Bitcoin's going up an order of magnitude as the age increases by 50%. So if we're age 17.2 years now, which we are, then in 8.6 years, we'd expect it 10 times from trend. And actually, you know, we're below trend by a factor of 2. So if we get back to trend and keep going roughly as trend, we would expect it 20 times within the next 9 years. So that's the long-term core power law that, you know, people that have watched this show before are familiar with. And then for the intermediate term, it's the next innermost layer, which is labeled as discrete scale invariance. So the idea is that you have this continuous scale invariance of the power law, but it gets interrupted. And my hypothesis is that the big interruptions are brand new capital tiers that come into Bitcoin that had not been in Bitcoin before. So you start out with, you know, cypherpunks and small retail, and then you have exchanges, and then you have some hedge funds and some sovereign wealth funds. And by now it's graduated to where the ETFs and the Bitcoin treasury companies, and to some extent some government funds in terms of pensions and strategic reserves, are the largest players. And you go up these tiers, it's more and more money, right? So when it comes in, it's kind of a big impact, and it can help support a wave or a bubble at discrete times. Now, this discrete scale invariance is inherent in the structure, is my argument. But if the external influence hits at the right time, you kind of get a compounding effect. And I'm focusing on the fundamental and subharmonic as the largest modes. The subharmonic is slower by a factor of 2 in log time terms or log age terms. And also some decay envelope, which is sort of a reciprocal of age roughly. So then in the outer layer, you have short term, and that's driven by macro and financial conditions. It's exogenous. I do also fit it with a slow reciprocal decline. I'll show you the measurement for that, how that fits. And you also can do some what's called gauge correction for autoregression of that. And when you do that, you find out that that noise, after you've removed these two longer and intermediate term intrinsic endogenous components of the overall model, that what remains looks like Gaussian noise once it's conditioned. Okay, so here are the steps. First, you fit power law. I use quantile regression. You could certainly do this with ordinary least squares. You would end up with roughly similar results. And you have first stage residuals, and then you do a Fourier analysis on those, and you find out what the intrinsic fundamental mode is. And it's the language we use here is lambda of 2.07. It's roughly saying that that time between peaks or peaks of waves is doubling. So if you had one at age 9, the next one would be at age 18, that kind of thing. And that's related to an angular frequency by this equation. It's 2 pi over lambda, except you use the log of lambda. Normally you think about 2 pi over lambda, but here we use the log of lambda because it's the log of time that we worry about. So that takes a particular value. It's just determined by that same Fourier analysis. And then you fit some higher modes, and I fit 2, 3, and 4 modes. And what I found out is that there are only 2 modes that really matter. The fundamental mode and the subharmonic, and together they give you an R squared of 0.5, which is really quite good for a financial series. If you add the next 2 modes, it only increases to 0.53. So in order to keep the model from getting too complicated and having too many parameters, I don't treat those here. But I do impose an amplitude decay, and that is based on a measurement for the fundamental, and it's 1 over the age plus 2 in years. Now the subharmonic turns out to be flat to rising. So what I did was I said, all right, we'll treat it with the same decay as the fundamental, or we won't have it decay at all. And we'll see what those 2 options give us. And that'll be the kind of conservative and aggressive bookends here. Having removed the log periodic modes, we then have our second stage residuals. That's the exogenous macro noise from news events and regulatory risk and exchanges failing and many sources. Although I found that one of the best sources is the financial conditions index, which I've talked about before and written an article on, but I'm not yet treating that here. And then you condition those with something called Garsh, and you find out that they're quite Gaussian with the new parameters over 200 if you try a T-location scale model. So once you're really above 20 to 50, you're getting pretty Gaussian. And then I fit the noise in log price, again with a reciprocal kind of model. And it turns out that 6 over h plus 27 is exactly the formula for the 1 standard deviation in log price terms. Having done all that, we can now project forward using the power law, the parameters from the log periodic fits, and then these values for sigma. And so we can show 1 and 2 sigma bands, and that's what I'll do. And here's the equation that has everything. It's got the first 2 terms of the power law terms. There's a little offset that comes from the log periodic, an offset term, that's C0. And then there are the 2 modes. R0.5 means the half frequency, half of the fundamental frequency, which is this W0. And, the log of age is in the expression, and then each one has a phase term. And then they're reduced with this damping term, which is this reciprocal, except in the more aggressive model, I don't damp the subharmonic term. So here are all the values. The power law intercept and power law index are familiar. The frequency we determined from the Fourier analysis, which is also validated by wavelet analysis. And then I've got an amplitude for the fundamental, normalized to age 17, the current age roughly. And the phase, that's in radians and degrees, that's like minus 72 or something. And then the frequency is the half frequency mode for the subharmonic. And the amplitude for that is lower. And, we turn it off in the aggressive, sorry, this is for the aggressive model. Actually, that should say conservative. But anyway, that's the amplitude, and we turn off the decay. So that's what the aggressive model, that would contribute more and lead to somewhat higher prices and its own phase. Okay, so here are the residual stages. The top chart are the stage 1 residuals after you remove the power law, and you fit the log periodic components, the fundamental and the subharmonic. And you get the orange line, and that has an R squared of 0.5. So it's explaining half of the residuals, basically. And then when you subtract that orange curve out, the log periodic curve with the 2 modes, you get the lower right, which are the stage 2 residuals. And you can see those are looking a little more normal. But this is actually before they've been conditioned. And then the next thing you do is you fit them for decline, and that's the little inset on the left. So then that gives you that blue line, which is a slow decline. So you apply that, and then you apply Garsh, and you get something that's quite Gaussian. Now here's the fit for that full set of equations and for that uncertainty. So we have just the power law trajectory is the green dotted line. The forecast zone is in the upper right. And then the orange line, which is kind of lightly colored through the history, is more darkly colored into the forecast. So you can see the difference that the log periodic modes, the combination of both fundamental and subharmonic, and yes, with decay on both, is still contributing a substantial boost relative to the power law trajectory for the next 4 years. They're both favorable and additive in the multiplicative sense. And then I've put 1 and 2 sigma bands around those. And I'll show you more detail now. So here's the detailed projection for both the conservative one where both modes decay and the more aggressive one where only the fundamental mode decays, but I leave the aggressive one flat. You can see that the power law projects that by 2030 you'd be at 400K. And the conservative model projects you'd be close to 700K with the boost from the log periodic waves. I don't even call them bubbles because these are not like sharp bubbles that go to peak and collapse, exponentially. These are more general kind of wave action that's getting stretched out longer and longer time because of the log periodic model. And then for the more aggressive one, it rises to about 800K by the beginning of 2030. Now, the slope flattens somewhat because the fundamental one bubble peak, I want to call it that, for that mode, actually occurs in 2028 once you include, phase correction. It would be mid-27 without including the phase, but it would be late 2028 once you include the phase in the calculation. So there is some slowdown in the rise, but it's still trending upwards. So the gap between the power law only and the forecast mean in both cases is growing, but it's getting to the point where it's going to start flattening out as we go into the early 2030s. And these are all the numbers at half-year intervals. So in the upper left, we have the age, we have the log 10 of the price from the power law, and then we have the additive amount in the fourth column for the log periodic wave in log terms. So you can see it rises from 0.06 up to 0.23, but it's sort of flattening out at the end of this time and the end of this decade. And so you sum the two, and that's the mean trend for the price, including all of that. And then the sigmas are shown. They're all around about 0.13. It's only slowly coming down. And that's what the multiplicative factor that sigma corresponds to. You raise 0.138 to the, make that the exponent for the base 10 to the 0.138 gives you 1.375. So it's like a 37% volatility, if you will. And then the other two charts, the upper one is the conservative set of numbers. The lower one is the more aggressive set. And you can see the trend up to near 700,000 and near 800,000. You can also see that $1 million is possible, but not that likely within the rest of the decade. So if you got to 2 sigma, then you could reach it in 2029, depending on what it is. I'll give people a moment just to scan those. Okay. So the model, I think that the main message here is that the log periodic waves look supportive for the rest of this year and the next 3 years following. And we obviously have to jump a factor of 2 just to get back to trend. But the outlook looks quite positive if you put any faith into this log periodic model. All right, and then the closing section is on the Kelly analysis, where we think about a portfolio that only has Bitcoin and STRC. And STRC has been on quite a roll lately. And I'm sharing a couple of charts. I had tipped to Marilyn Hodel for 2 of these. One of them is from Strategy themselves. They say that the Sharpe ratio for the STRC, which is preferred security, it's tax deferred because it's return of capital probably for the next decade, and high yield, currently 11.5%. And, trading at par or slightly above par today. They're saying the Sharpe ratio is 3.1, which is incredible. SPY has a Sharpe ratio of 1. The Sharpe ratio is just the return divided by the standard deviation. You can correct for the risk-free rate, which right now is about 4% in T-bills.
Yeah.
NVIDIA has a Sharpe ratio of 1.7.
Yeah.
Is there a question or comment?
No, Sharpie 3 is like almost like a unicorn. It's really difficult to get.
It is crazy. Yeah. I mean, gold has been doing well as of late, so it's got a high Sharpe now. So it's saying that the return is very well. We know what the return is. It's 11%, but the volatility has been low. It's been a factor of 3 lower than that, right? So we're saying basically you've got nearly 12% return with 4% vol, less than 4% vol. That's what it's saying. And actual numbers below, comparing not to T-bills, but to the 10-year U.S. Treasury, yield of 11.5% paid monthly, compared to the Treasury is just over 4%. The 30-day historical volatility for STRC is lower than that of the 10-year U.S. Treasury. And the Sharpe ratio is, 10 times higher, basically. So one is backed by, and the other is backed by real assets, right? And as we know, the dollar cuts in value about a factor of 2 every decade. That's how fast the money supply grows. And if you collect 4% on a treasury, you don't keep up with that because it's, the money supply is compounding at 7%. STRC will keep you ahead of that curve, and apparently with low volatility. I think they've kind of figured out how to keep it constrained. They want to keep the price between $99 and $101. So they want to keep it in that range, and then they adjust the yield as they need to in order to keep it there. And they've got plenty of coverage. And then this other chart from Marilyn Hodel and from Chris Reed kind of describes, the potential for what it's doing. The fiat system is under stress. Purchasing power is melting. Do we have stable money? Well, certainly not stable over any long time periods. Banking model is threatened, really ever since the Great Recession. It's been under stress. And this reflexive feedback loop that has created with Strategy, and STRC is, he's had a series of prefers, but he's really unlocked, built the biggest channel or sluice, really unlocked the dam with STRC. He's having the most success for that because, it doesn't vary much in price, and it's providing high yield. It's appealing to certain classes of institutional investors, such as insurance companies and pension funds, for example, that have a lot of difficulty meeting their targets and doing duration matching. So the idea is capital inflow. It strengthens his collateral, and that allows him to issue more STRC. So it's a very nice reflexive loop that's been constructed. And in the long term, this helps build a Bitcoin monetary system. And so one can say in only a half-joking manner that SDRC has aspirations to be the definition for the new risk-free rate, but within the Bitcoin system, not the traditional fiat system. So based on that idea, I said, okay, what if we have a two-asset portfolio of Bitcoin STRC? Maybe I want to have some income, maybe I'm retired, or maybe, I just don't want to be 100% in Bitcoin. And in fact, Kelly tells you probably shouldn't be. That's getting out over your skis. At least the gambler's traditional Kelly, which is what this one is. And this is based on annual returns. If you use shorter windows, you'll find actually lower allocations to Bitcoin. So the longer window you use, the higher allocation you'll get. So this shows the Bitcoin returns for the past 15 years. Percentage gain and loss. There were only 4 down years. Last year was down by 6%. If you subtract the risk-free rate, you get the numbers in the next column. If you compare to STRC and subtract 11% and say that's kind of a risk-free rate in the Bitcoin ecosystem, then you get those numbers. So I haven't gone all the way back 15 years. You would get even higher allocations. The problem is we know we're on a parallel trajectory, and it's unrealistic to expect returns of more than 1,000% in a single year going forward. So I've used 10 years and 6 years to see how much those vary. And for the 10-year, you win 70% of the time. And so P is 0.7, Q is the percentage of time you lose, it's 0.3. So 7 out of 10 years were winning years. And then the average win was 329%. The average loss was 48%. There were 3 loss events or 3 loss years. And then you subtract the 4% or the 11%, depending on whether you're comparing against T-bills or STRC, and you get slightly different numbers, slightly larger for the losses, slightly lower for the average win. So the way that this Kelly formula works, should have written here, is basically P minus Q over B. So P is the percentage of times Q is the percentage of times you lose, which is just 1 minus the P. But then to get optimal Kelly fraction F, you divide Q by B. So you take P minus Q over B. Well, what's B? B is just the absolute magnitude of the ratio of the average win to the average loss. So it's about 6. If we correct for the T-bills, it's 6.2. If we correct for the 11%, it's a little lower, it's 5.4. And then when you calculate F, it's 0.64 to 0.66. It doesn't matter too much because the B is so high and the P is high. So what that says, if you have a look backwards for 10 years, you'd say I would put about 2/3 of this portfolio into Bitcoin, and I would put 1/3 into T-bills or STRC. Stable coins, but they don't pay yield, unless you go stake them. So realistically, why wouldn't you put it into STRC? I mean, if you kind of have faith in the Bitcoin world, STRC is going to do fine, right? Then if you look back 6 years to do a sensitivity analysis, how much do things change? Well, now the win rate was 4 years out of 6, so it's 0.67. The loss is 0.33, 2 out of 6. The average win size drops to 150% or so, and the average loss size is, minus 35%. Correcting for the 11% on STRC, it's minus 46. So B goes down, it's more like 3 to 4 here. But then when you plug it in, you've got 0.67 minus 0.33 divided by 3.2 in the worst case. So that's 0.56. So you still should be allocating about half or more into Bitcoin if you have a 2-asset portfolio, that on the other side has T-bills or STRC. So I raised this question: do we have a new 60/40 here? Now the 60/40, BTC is the 60 roughly, and STRC could be the 40. So that's using the traditional gambler's formula, where you have a bunch of discrete events and you look at each of them as a bet, 1 year windows, and you would rebalance every year under that formula by adding, and recalculating the new F value. But you can also do a continuous Kelly, and it kind of treats the fact that you're not going to completely get wiped out. So it looks a little bit like Sharpe, because in the numerator, it takes the mean expected return, it subtracts this R, this risk-free rate, but instead of dividing by the standard deviation, it divides by the variance, which is the square of the standard deviation. So it's more aggressive, one could say, than the Sharpe, but it's designed to grow your wealth, the log of your wealth, in the most optimal fashion. And, it's valid to do it with the treatment that I've just given, which is I took out deterministic structure, I took out cyclical structure, and I'm modeling the remaining noise. And I'm actually showing, though, I'm not using the somewhat lower sigma that I found from that modeling. I'm using a somewhat higher value that I pulled off the strategy webpage as the historical 1 year volatility of 43%, but I'm also expecting that it will decline. So I applied a very modest decline, like a slow square root of age decay. So I'm only dropping it down to 40% in the out years. Now, the mean expected return just comes from the power law behavior. So it's just dependent on the power law index and the age. And, to first order, it's K over T, where T is the age. And to second order, there's a correction term of 1 plus 1/2 K over T. And there's a more precise formula that gives you 39.3% for the next year. And then for the out years, it drops to 37, 35, and then 33%. So just for this year, if I apply the T-bill rate, 4%, it says 191% is my optimal Kelly fraction based on this continuous Kelly formula. And even with the 11% rate from STRC, subtracting that, it still says 150%. If I use those same numbers to calculate a Sharpe ratio, they're like 82% and 66% for Bitcoin itself, and slowly going down. So solid, but not at the level even of SPY, because volatility has been high. And then in the out years, the F fraction drops a little bit, 148 down to 138. So a full Kelly says you could go long with some leverage, right? 140 to 150%. So you could be leveraged 3-2, kind of a thing. People often don't want to use full Kelly, so they use half Kelly. Well, that would put you at 70%. And even Sharpe says you would have a 60% allocation to Bitcoin. So with this continuous Kelly criterion, it also supports the idea of a 60/40 with Bitcoin having 60 or 70% of a portfolio, and the rest, STRC if you believe in Bitcoin and the ecosystem. And then you get some interesting levels of income as well. So that's it. And thank you very much.
Okay. A lot of material, like always. By the way, I suggest everybody, because this material in these shows are very intense. There is a lot of information. This is why we record them. So, go back sometime and rewatch the presentation, stop. You can always contact us, me, and we have a active X account. So you can ask questions about the shows. It should be an interactive process. But I always say, I think this is the only Bitcoin show where almost every single week we present new discovery about Bitcoin. And it doesn't matter if it is a small improvement, a small study that adds depth to our previous studies, but it's new insights, instead of just discussing what BlackRock has done last week. We almost never cover that. Occasionally, if it is relevant to what we are discussing, but it's about adding new information, adding new depth, new understanding, and trying to improve our convictions. That Bitcoin is really a fascinating topic, but also something that can change our life as an investment, long-term investment. And we are looking at your questions. Please ask questions. We will address them at the end of the show. All right. So when is my turn? I'm going to start with an update on the power law. So this is one of my latest favorite indicators. I have many of them. Like I mentioned a few times, we have about 16 different Bitcoin indicators, all based on some variation of a power law. Eventually, remember I told you about perks that you will get if you are a member of an institute. Some of these indicators, a big package of these indicators, will be available as a perk, if you become a member. So, the work of the institute will also help people to navigate the price, where we are in the cycle, and so on. So what you are watching right now here is a simplest possible power law. In fact, I call this indicator simple power law. It's just a red line showing the reference line. There is the floor that is about 60% away. The top line, we discussed this many times. There is not really a similar line for the floor because the peaks are actually decaying. It's part of a model that actually Stephen was talking about. We have other indicators that try to model these tops. I think actually I should add Stephen indicator, with um, the with these bubbles that are log periodic instead of being periodic. Log periodic means that we are going to be farther and farther apart, right? But it's a very interesting model. I could reproduce it actually, but it's something that can work in the next few days, and we can make an indicator out of that. Stephen, I'm going to actually implement your indicator. I want to see it on a trading view chart, if you don't mind, and then we can make it part of the package we offer to the institute members, so we can give it to them, because I'm going to give my IP to with all these indicators to the institute as my contribution. So if you don't mind, I can implement it.
Let's do that.
Yeah, that will be cool. And of course, I will give you attribution. Um, it will be curious to look to plot it on a chart that is updating all the time. Here you're seeing what I found curious is that the price. You see, these are what these yellow and red lines are trying to indicate that even when we go down, then for some time we still follow the power law. It has to be, because if a overall tendency is moving along the power law, most of the time we should catch Bitcoin doing. I say all the time, I use this expression, you guys should do most of the time power law things. You should move as a power law. And that is exactly what you see. Even now, that it seems we are not doing anything, you can see that we are moving in a parallel fashion along the power law. And then, if we go back to reference, it will be probably very fast movements. We already noticed these, the transitions are very fast. And then you stay to some kind of a level and you move along this level according to the power law. And many people think these are times where we move sideways, but simply because the power law right now is growing relatively slow, it's still moving very fast, right? We're talking about 10 pairs in the next 8 years, 20 pairs, 100 pairs in the next 20 years. But on human scales, it starts to be slow. But Bitcoin doesn't think in human scales; it thinks in log time scales. It has a long, it has a slow preference time. You know, it's actually the mathematical incarnation of slow preference time. And this indicator we see below is based on this idea of slopes. In fact, um, Stephen was talking about the Sharpe ratio. In a certain sense, this is kind of Bitcoin based Sharpe because it measures the mean value. So Sharpe, do you remember where Sharpe was from, Stephen? Which kind of what was his origin? Is he American, Anglo-Saxon?
Yeah, it's American economist. Mark
Economy. Yeah.
Sharp. Sharp
So
is the guy's name.
so
Yeah.
he defined it as the mean of the the returns divided by the sigma, right? The variation, the volatility, basically. And the logic behind it is a good investment should have a large returns without exposing you to large variation in the returns, right? Because if there is too much variation, you could lose everything. Yes, okay, overall you are gaining. Let's say you have a big mean, but it takes just few bad days, right, to wipe you out. So some people have a problem with the Sharpie doesn't measure. It measure equally going down and going up. So there is a variation of it that is called the sortino, where you divide only by the negative values. So if you have a relatively large positive values, is not counted because that actually is good, And with Bitcoin, actually, in fact, actually, maybe you can add sortino in a further analysis, for what
There's
you.
something important to understand. Sharp is really better for ranking things, or Sortino, if you want to rank that because you're risk averse. But it is not really telling you the optimal strategy for future return.
Yeah.
That is better done with a continuous Kelly compared to the variance.
Okay. And so here I'm creating like almost like a kind of a signal to noise ratio. It is basically the same idea of a Sharpie, where the signal is the mu of a distribution of the slopes, and the noise is the sigma. How much of variation you have at these slopes, and this is what you're seeing here. And it's very good in identify bullish times versus bearish times with a color code. Green is bullish, red is bearish. And right now, basically in the last few days when we went to 70, 71, it seemed that we were leaving this bearish region. You could take it as, we kind of reach the bottom. You can see there is like an inflection there that could indicate that we did reach the bottom, but we are still in this transition area between bullish and bearish. That is one of the analysis. I could try to modify, make it into a sortino and divide the positive deviations from the negative deviations. But I really like this indicator. It's very interesting and very useful. So this is an analysis about where we are right now. We are still moving forward. We didn't touch the support. Um, I think I'm okay with where we are with Bitcoin. Um, all right. Beside this, I did a lot of other interesting studies. I've revisited some old results because I'm writing the book. By the way, I have this book that is called The Physics of Bitcoin, exactly like the show. And it's out for pre-order. You can check it out. I have also, you can visit, it's all together, one single word, thephysicsofbitcoin.com. And it's going to be a very cool web page because I'm going to have live charts there. I'm going to have a lot of supplementary material for people who want to dig in. Eventually, we are going to link it to a scientific Bitcoin Institute. Is going to be one of the reference, but it's going to be kind of like a learning place if you want to learn how to do power laws. There will be some code or maybe some prompt that you can use with ChatGPT or Claude or whatever. So if you want, because discovering things yourself and doing things yourself is one of the best way to learn. And so the website will have tabs, with different exercise, with different maybe like a laboratory to test many different things about Bitcoin, some of the graphs that we were creating. So please visit it. And there is also a link to the book. So if you want to pre-order it, and the book itself will be launched in mid-April, so sometime next month. Okay, so by writing the book, and I kind of did few new things and few old things, but better. So I'm going to show you a few slides. Okay, so this is one very interesting. Okay, maybe before this, let me do this. Somebody posted, actually, I don't know if you saw this, Stephen. In fact, let me do slideshow. Okay. Does it look? Yeah, I think it looks better now, bigger. Have you seen this slide, Stephen? Have you saw this?
I don't recall seeing that. No.
Yeah. So this was at the conference BTC Prague, and you know that Saylor tries. He says it's a funny thing, right? Because first of all, he's in the business of making financial prediction. I think it's one of the things that his company actually does. It creates software to make financial prediction, among the other things, right? This is part of his business. But he's often quoted, I think it was actually a misquote, right? Because he was talking about microeconomics model. He was not talking about models in general, in particular models of Bitcoin.
Oh, yeah.
People want it all the time. All your models will be destroyed, etc. Right? Because people don't want. I don't know what is there is.
Models will be broken.
Yeah, will be destroyed or something. I think because I don't know what is the fascination with that. Mostly because I think people think that means Bitcoin can do anything, right? And in fact, one day you wake up and there is one of these silly God candles or mega candles where Bitcoin goes all of a sudden within a day to $1 million. What do you think will happen if that happens? It will not happen because people will short it immediately. All the financial world will try to short this crazy thing. This what that it will be actually a bad thing. It will be a sign of instability of Bitcoin or maybe the world. We don't want that. But some people dream, maybe we have some kind of immaturity. So I think it's like, this hero of them is saying that Bitcoin can do anything. It doesn't. In fact, himself has these models, right? He came up with some time ago with these Bitcoin 2025 or whatever it was called initiative, where he was making projections for the future. They were so wide. Basically, it was like a net that was to be, he had all kind of sizes of a net, gaps, so you could catch anything at all, small fishes, big fishes, anything. It was completely meaningless, right? You had a bear scenario, you had a bullish scenario, just to say, well, it could go here, and then you had a middle one that it looked basically like the power law, and in fact, I think he's using the power law without attribution, and he doesn't call it like that. For example, he was calling it like an exponential with diminishing returns. An exponential with diminishing return is a power law. That is exactly what it is, because we are all both multiplicative processes, and the difference is that you have this decaying time of a returns for the power law. While with an exponential, you have a constant compounding gains. So it's silly. And then, of course, if you can project where Bitcoin is going, you can also calculate the annual returns. So in this graph is showing the real annual return. The problem with this is, you have to pick up a particular day when you are going to calculate the annual return. You can do it end of year or whatever, right? But with Bitcoin, it's kind of arbitrary. Yeah, maybe end of year is meaningful even for Bitcoin, but not necessarily, right? So it's better to do actually some kind of a moving average. You can calculate what is the annual return at any particular point, like if you want to do it daily, and say, okay, if I go back 1 year, what will be the return for this particular day? You can actually measure it in that way, and then do a rolling window, and then you can calculate different parameters here and calculating the median. The median is better than the mean because if you have like a large variation, right? Like we have these huge big peaks, and then we have this bottom. So it gives you something better, and you can see kind of very much approximates actually the actual trend. So the red one is the median of these annual returns on a it's a continuous measure because it's not done year by year, it's done continuously day by day. And then the blue line is the power law, the theoretical prediction of the power law. And you can see the real value starts to approximate more and more the blue line, right? The problem with what Saylor is doing is, he needs to know where to start, where to end, and then he can kind of fit some kind of exponential decay. The decay of the power law is not quite exponential, but it's going to look very similar. But it's not done by
Right.
fixing the starting and the fixing point.
It's a reciprocal, right? Basically a reciprocal. So
Yeah. So and so they are similar, but I think what is going on there is that he's basically quoting the power law, because if he had just to guess, how does he know that it is going to happen? It's going to end on 21% by 2046. He doesn't know.
right.
It will be just a lucky guess, and it will be arbitrary. While the power law works from first principles, right? We are saying we have all this evidence that it fits the data, it really works as a good model, so you can use it to make prediction towards the future based on something real. Otherwise, well, Saylor said, how does he know? Where is his math? Where is his I don't know. What do you think? How does he justify that this is what is going to happen? He cannot justify it, right?
Well, maybe he got lucky. He just fit a decline, right?
Yeah.
But he arbitrarily just says it's going to go flat at 21, which doesn't make sense either. So.
Yeah, because probably, again, I really believe that he's aware of the power law, and he doesn't want to mention the power law because maybe it's still controversial, or maybe for political reasons, let's say. So he's coming up with some decay, and he kind of knows what the power law says, that it should be around 21% by that date, and then it's flat simply because, to be honest, if you look at the power law, it's becoming flat. It's not going to
That's the
change
wrong
much.
number. What year is that? What's his last year?
40. So the power law says 20% by 2041. So yeah, it's kind of
2041.
yeah, he's off, but by not much, right? It's pretty close. So I don't know what he's doing, and you can get different number by using slightly different slopes, etc. But it looks extremely similar, So I don't know why he's doing this thing without, quoting the power law and say, look, we have this model, it's the best model out there. If we continue to follow, this is going. this is what is going to happen.
It's engineer. It's not physics. It's engineering.
Yeah. Okay. Yeah. Kind of guessing. All right. The other work I did was this, right? Um, there are some people, maybe I should, okay, let me mention them by name. There are, in particular, Plan C, right? Plan C is doing it again. I don't know for what reason, maybe because he wants to have his own version of a power law. And that to me is, beyond the personal issues, it doesn't matter. It's more like, why you're telling people, the power law needs to be fixed, and you have this fix. His fix is he wants to add some kind of exponential, some kind of a decay to the to the median value of the power law. And it's not the right approach, because one thing is to talk about the decay of a deviation, and one thing is to talk about the decay of a power law. There is no decay of a power law. The power law is stable. Because if you're saying this, basically you're saying the power law is not doing what it's supposed to do, but is being scale invariant. Scale invariant means the exponent doesn't change. Now, there are times where the exponent changes, but most of the time is a sudden change because there is some kind of phase transitions or whatever. I'm not very aware of many power laws that change the exponent in time with a decay. Plus, the decay that is invoking is so small, it doesn't really change anything. And people have done analysis about that he's making a big deal. But the problem is, it gives this message that the power law somehow is tainted or is not holding. And there is an entire chunk of the Bitcoin community that is feed of that, that they don't like the power law. So, the message is the wrong message, this why is upsetting me. And so, look, we have a sophisticated test to measure, and also is looking at the wrong thing. The reference line, we are using it some kind of educational or maybe a simplistic way of representing the power law, but it's not really the core matter about the power law. The core matter is this scaling property. But we do not have really a reference line. Like, maybe you can create a reference line. I did, for example, by using Monte Carlo simulations, when you can show that, if you use the inherent stats of a power law, and you create many, many possible paths, the median of all these possible paths gives you something that looks like the reference line of Bitcoin. Even less fundamental, because again, we want to communicate the right ideas and the right science. Some people think, for example, the famous support of the power law that is about 60% deviation from the trend, is another way of testing the stability of the power law. It's not. It's just amazing that the price is actually confined within that range, and that it's a big deal, because remember, the power law, it's all about factors of 10. So the fact that we have this border at 60% that is close to a factor of 2, it's crazy, because we really say factor of 2 should not matter, because the relationship that we are discussing has to do with orders of magnitude. So only when you change order of magnitude, you can see if we are following the power law or not. Factor of 2s are nothing. So even these corrections, for example, that everybody is fearing or being disappointed or being scared about, is nothing, because it's a correction that is within a factor of 2. So basically, the power law doesn't even register it. So, you have to start to think in terms of factor of 10. For some people, they think if that is the limitation of a power law, they say, well, it could be anywhere within this range. Well, in a sense, yes. In a practical sense, no, because actually it turns out the power law is much more precise than that. But you have to understand that factor of 2 are nothing for Bitcoin. But we have much more sensitive ways of measuring the stability. In particular, this idea that over time we are scaling with this property that we described, right? And one way that doesn't invokes regression, it doesn't invoke all the other relatively simplistic tools that people use, is actually to use this idea of slopes that I described many times. Basically, I'm doing almost the opposite of what most people do, right? Most people create the regression and then they look at the residual, that is what is left over. I do the opposite. I say, let's normalize, or let's correct for this long-term trend, and then let's see what is left over. And if you do this operation correctly, you basically get what is called the slope, right? And in theory, if we follow perfect power law, this slope should be a constant. But because we have noise, right? Because as these two processes, there is noise, there is all the uncertainty of something that is traded on a market, etc. It's still a financial asset. And then these long-term property that come from the fact that become self-organized through the difficulty adjustment, through the network property of a system, and so on. And so you have the two things combined. And here I'm combining together and then looking at the properties of this quantity called the slopes. And so the idea will be that this n can still change, but it should be stable. What do I mean for stable? Well, it goes back and forth around a particular value, and that value turns out to be exactly the same regression value that we found, close to 6, right? 5.8 or whatever. And that is exactly what we observe. And in this graph, I did it at different scales, right? I did it using daily steps, monthly steps, yearly steps. So I'm looking at changes in the price over a day, over a month, over a year, and then I normalize it by this factor of time that is the log of a time difference between these two points in time, right? These steps. And this quantity is stable. And you can see it, right? Because it's oscillating at different speeds, right? Because there is a lot of noise at the daily level. And you can see these dots. The dots are the single values, right? So basically, these normalized returns, the red ones are days where we are negative. So we basically the ratio is less than 1. So we are in a negative day, right? And the blue ones are positive, and this yellow line is kind of a moving average of these values, right? It's very difficult to see if there is a pattern where if you just look at the dots, but the moving average reveal it. And you can see it's pretty consistent. And what is amazing, you can go all the way, right, to 2010. If you use a regression, you cannot see the power law at all, because we were this very large bubble that confused the data. And if you if you use a log graph of a data up to the first few years, you can draw power law if you want, but it's very different from the current power law in terms of a slope or whatever. Not with this method. This method is resistant to that. It shows you how superior it is to any regression model. It doesn't matter which regression, even strong regression methods, like unless you throw away so much outliers, and then maybe yes, you could see a power law, but you will have to throw the majority of the data, because there were these huge big bubbles that form the majority of the data. So, but this method doesn't care. I'm not throwing any data at all, and I can still see that oscillations around this value, that is this line here that you see here, that is the power law value. And you can see it's stable because, yes, it can deviate a lot from it, right? So remember, the average value should be around 6. We can go all the way to 200, 300 in both directions, but in average, we always go back to that line, that from the start to now. So this is one of the most striking evidence of a stability of the power law and how consistent it is. We don't have much data before 2010, but I bet if we add it will be still there. It's incredible. So we have a very, very, very stable quantity that shows But the power law has no change. It's the same power law, at least in terms of this quantity that is the mean of a slope. Now, there are some changes, for example, in the sigma, that is the variance. You can even see with your eyes. Look at this. Look at this. You can see with your eyes. You see how it is kind of closer to this line. These dots are closer, and then all of a sudden there is a jump, and there is. It's almost like it's. I love when data can be studied with your own naked eyes because it's the most intuitive thing, right? Then you can confirm it with more sophisticated analysis, but your eyes already guide you there, right? The same thing with the power law. That is one of the things that are so amazing. It's clear that all the people will say, "Oh, it's a spurious data. What are you talking about? Look how straight this line is." They don't know what we are talking about. They are not being trained in breathing, living, eating the data. I do this since more than 30 years. So you can see here, look, it's already clear that around 2017 there was a jump in the variance. You see how much more variability there is in the data, right? But even if look, this is another interesting thing, the variability is bigger, but the mu stays there in the middle, so it doesn't change, right? And that is really what counts in the power law. And it's a counterintuitive argument because most people think that actually the variability has decreased in time, not in terms of this variable, because this is a really variable account. What people confuse is because there are diminishing returns, the variability is also in absolute terms smaller, but not in relative terms. In relative terms, is actually bigger relatively to the early days. Okay, this could be, and I am curious what Stephen thinks. It could be a sign that actually this is when the institution came in. During 2017, people think that actually it happened most recently, but there were large banks and some big investment firms that started to come in during this time. But something really drastic happened during that time. And then we can also use monthly steps. Okay, there's much more structure there, and there is even more structure if you use yearly steps because now it reveals the bubbles, right? What is happening during the bubble? These are the bottoms. These are the bubbles. We didn't have much of a bubble now because we were not supposed, according to Stephen model with log periodic, we are not supposed to have a top during this time. People expected one, but it was not. So these are really interesting graph. It has a lot of information, but it's really the ultimate test to show that Bitcoin is doing the same thing practically since 16 years. And everybody should memorize, study, and understand this graph because it's so powerful in what it's telling us. Stephen, do you have any questions about this? Or do you any comment?
No, I mean, my comment is that it's incredible how good it was in 2011, 2012, 2013.
Right.
Because with regression methods, you don't see the lock-in until 2016.
Yeah.
And I think it was because of your trained eye that you were starting to see the power law in 2013 and 2014, right?
Exactly. Yeah. But yeah, I love these because they tell us that if you really look at the main important quantity for Bitcoin, which is these scaling properties that have nothing to do with line fitting, with regression, with a reference line, all the things that some of the other analysts are talking about. This is why, it's not about gatekeeping. We don't want to keep people out. It's great that there are, this new era of a citizen scientists, right? This is actually how science started. It was made at the beginning, the 1700s. It was made by many wealthy people. They were landowners and they had a passion for science. It was more like a hobby for them. There were many scientists like that. But, you need to be still very prepared, understand what you're talking about, having all the foundations, and, and it makes a difference when you have 30 years of experience working in many different fields in analyzing data, and plus you have this foundation of it. I think is so unique that physicists have, because we try to go to the root cause to look at the mechanism, and many people, unfortunately, they don't have that mindset, and so they are trying to do kind of amateurish things. And again, I'm not trying to make this personal, but I do care about communicating the right information to the public. So let me repeat one more time: the power law is fine, is still doing exactly what has done for 16 years. Uh, then I have this other graph that I have worked on. That is another. I already done this analysis before, but I love aesthetics. I think this is another thing. Of course, I got the help in this case. Claude helped me to do this. I did that this graph before, but it looked much less aesthetic, than this one. This is beautiful. It looks almost like different galaxies or something. And they are different galaxies in the universe, And on one here we have Bitcoin. So what did I do here? It's very similar idea because basically it's the same idea over and over from different angles. It is how you go deeper in something, right? So again, here, what do I have? I have on the y-axis, you can see the only thing I should improve in this graph is making these numbers maybe white, so they are easy to see in this background than just gray. But this is the log. So basically, this is how it works. This is how graph is constructed. Okay, so let me explain it to you. So I pick two random dates, right? And these dates can be the order of these dates doesn't matter, right? So this is why this graph is symmetric. I can have dates where the first date is early, right? So for example, if we think in days from the Genesis block, it could be day 533. And then I pick up another date that is day 1399. Right now we have something close to 6,100 something days from the Genesis block. So I ask a computer to randomly pick couples, right, of days, and then look at the price at these 2 days, the real price, and take the ratio of these two prices, right? So the computer takes, like, of course, when I have large differences, these probably are days like something close to today all the way to early days, right? You see, for example, here, and these are logs, right? So I don't know if you use a base 10, probably, but if it used base 10, 6 means a million, right? So there is a difference of a million in price or something like that. Or maybe it's not, right? Because I think it was just few cents. So probably the biggest number we can get is 100,000, but it doesn't matter. So it's basically taking the ratios of these values of a price, and then it's plotting it in the x-axis versus the ratio of the time, right? So I told you the days, 532, whatever it was, 1,000 divided 1,200. So it's how much time is changed, right? So how much time is passed by. I take the log of that. I take the log of the price. And you can show, I'm not going through the mathematics, but that is exactly so basically we do this because we are expecting, if you apply the formula of the power laws, we say, let's assume we are dealing with a power law, then what we are expecting of between these two variables should be proportional to each other. And in fact, the proportionality, basically I'm expecting a straight line, and the slope of a straight line should be n, should be the exponent of a power law. And in fact, this is exactly what you do. And this is completely different than doing a regression. Yes, I draw a regression line there, but I could do without, right? Even if I didn't do this, you could see the data, it's a straight line. It's a fuzzy straight line. It's so clear just by looking at it, right? Again, that is one of the things. I had a very good advisor, very good mentors. This mentor that told me, don't even try to do any math, any analysis. Look and stare at the data for several minutes, because that gives you an intuition of what you're looking at, right? That is the first step. Of course, you don't stop there. You go further. You do many analyses. But I saw so many times the opposite. People do all these crazy analyses, and then the data was trivial, so it didn't have really any information, and all this stuff was basically fake, or you know the other way around, where they didn't realize basically, if you don't have intuition, all the other calculations maybe can help you a little bit, but you don't go very far, right? And so you should do back and forth. You should do intuition first, then analyze it, that supports intuition, and then you go deeper, you improve your intuition about what is going on, and it's like two legs that allow you to move forward. So here you can see, just by visual inspection, that this behavior is so different from everything else. This is Nasdaq, this SP 500, this gold. None of them move along this line. These they form these curious kind of like rebounds or S curves. Gold is really dramatic. It's actually the strongest one in terms of how different it is. They form almost like this S, right? And again, they look like galaxies. Like there are some galaxies that are warped, like that, and these
We,
looks like,
we have a beautiful spiral with Bitcoin.
yeah,
Did you
like a
say
beautiful
phenomenal,
spiral.
beautiful
Is
spiral?
Yeah, that
And then
actually,
these others are irregular galaxies. They're undergoing
yeah,
tidal effects from neighbors, all of them.
yeah, exactly. And
Yeah.
and this is due to the fact that they are exponentials mostly, and sometimes not even consistent exponentials. So there are different regimes, there are different situations that happen to them, maybe different market conditions, and you can see you can still try to fit it, a line, and you can see it doesn't do a very good job in fitting whatever is going on there, because it's giving, see, the line, the fitting, this part of why regression is problematic, is giving a lot of value to these data points and these data points, even if a majority of the data is here, uh, basically doing nothing, because these are extreme. It's almost like leverage, and so it looks like this bent line, right? So it doesn't. It's not a power law. Like, this is so clear that it's a power law, and so these R squares were relatively high because there is such a big, huge variations in the data that you get this leverage effect. But that shows you how difficult it is to get 9.5, right? People don't realize there is a huge, big difference between, even if it seems okay, still pretty high value, it's not, right? This is crazy. This is almost perfection. Yes, there is still some fuzziness, but this is basically like not a signal. Maybe there is a little bit of hint of it. Yeah, okay, stretching it along this direction, but it's
You
not
know
a
what
power.
would be interesting? The slope is 4 to 5 times higher. It would be
Yeah,
interesting to put these all on the same chart,
yeah, we'll do that too,
and you would
because
see
they will look almost flat. They will
difference.
look almost flat. Yeah, and it's, yeah, so it's really striking. It's beautiful. You can learn so many things. In fact, I think actually this is an innovative method. I never saw anything like this, because I think people don't do this. They don't have a need to do this, to show that something is scaling variant over many years, many order of magnitude, and so I even have an order of magnitude. Look at this, right? So we're talking about 1 to 1 minus 1, right? It will not even qualify as a power law, really. Here we are having 6 order of magnitude, right? So huge, big changes in magnitude, almost perfect power law. R squared, it is crazy. um, Huge, big slope. What else do you need to tell you that Bitcoin is a power law? This is one of the most striking, beautiful tests. Stephen, we need to write a paper about this, because I think it's
Yes.
so fascinating and unique. I don't know if there is a, and we can try to put all the other assets. I mean, Nasdaq is mostly driven by few of these assets, Nvidia, Google, whatever. But we can break it down in all the different assets. We can add silver, anything you want. They will look all like this, while power law is the only one. I don't know how more of a case I can do. And anybody that, all the people will say spurious, is not real, blah, 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 blah. They don't know what they're talking about. They didn't work enough with the data. they don't understand it. They don't have intuition. They don't have feeling. You have two astrophysicists here that know power laws more than all these critics combined, and there is absolutely no doubt that Bitcoin is a power law. Do you agree, Stephen?
Without a doubt. Without a doubt. It's a power law, but volatility is high, and this confounds people.
Yeah.
And they're not used to thinking, this is 7 or 8 orders of magnitude
Yes.
that it's extended over in price. But
Exactly.
in time, it's extended over 1 order of magnitude, basically,
Yeah.
since price discovery, or a little bit more than that. And,
Yeah.
people are just not, they never look at log charts. They
Right.
never look at log charts.
Yes, and it's difficult to think in log terms. After some time, it became second nature, and actually is almost the best way to think about almost anything. In particular, because the universe has many different scales, right? In our lives, like nature knows. For example, you don't realize that your eyes do that naturally. When you go from a dark room to outside, your eyes calibrate the light exactly using logs. That I discuss that in my book, and it does because if you add a linear scale in sensitivity, everything will fry. I mean, you will not be able to handle the information. There is too much change between the darkness of a room and the light outside. So all you will be sensitive only to the light outside, and you will need big, huge sensitivity. Huge, big filters, only to be aware of a intense light outside, or only the light inside. But because of our lifestyle, right, we lived in caves, and then we went outside hunting, etc. We developed this big range uh, of sensitivity to light, and you perceive the changes in a linear fashion, but it's not. Every time you see a small change in light, actually, is huge, big changes of light. um, when you go outside, let's say you think, oh, light is maybe 5 times more intense than outside. No, it's actually 100,000. What you think is 5 is 100,000, because 5 is the scale. You have like a scale sensitivity to light. Same thing with sound. Same thing with sound. This is why we can, the human eye can perceive in a dark room. They say that even up to a photo, we can even see one photo, and then we can stay outside when there is very intense sunlight. That is due to this phenomenon of scaling. And so people should be really familiar with this, because it's something that drives your life. And if you want to understand Bitcoin, if you don't understand scale, you don't understand Bitcoin, period.
It applies to sound. That's what the decibel scale is.
Yeah, also
It's the
sound.
same thing.
Exactly.
So
And so then I did this other thing that is also something not completely new, but it's a real elaboration. So I try to draw the three-dimensional power law. It is basically, I have a log of price on this axis, I have a log of addresses in this, and I have a log of hash rate. And you have a beautiful power law that shows the interaction between these three things. But I went a little bit further, and I have to be honest, actually had a little bit of help, because I have this beautiful discussion. It's like a lab assistant, a very clever lab assistant. And I start to prefer Claude. Sometimes I put them in competition. I go to ChatGPT and say, hey, Claude say this. What do you think? And it's so funny because they compete with each other, say, oh, I think he's right, but I can tell you something better. Will you like to? So they actually compete. But I'm kind of, it's like almost like parents that have a preferred child. I prefer Claude right now. I lean towards Claude. Um, but he was suggesting that actually you can think in this way, that the two-dimensional power law is a line, and then when you go to the three-dimensional, it's actually a plane, because you can make a model like this, right, where you can say that the power law of H depends, and you can probably do it in a circular fashion. You can describe a price as a combination of addresses and hash rate, and vice versa. And probabilities, maybe it's a feedback loop. We didn't do that yet. We'll have to do some kind of Granger causality or whatever. I think you did some studies like that. But in general, the idea is that you could make a kind of multivariate model of one of these quantity in terms of the others. And this point was, given the power law in addresses higher, then means the hash rate is more influenced by addresses than the price. I don't know if you agree on that, but it seems kind of interesting argument. It requires, I think, more attention. I asked to do a full multivariate analysis, showing what affects what, and I'm just starting, but I'm already getting some interesting results. So it's a very interesting approach where, okay, let's put them together and see how they interact. But I like this idea that there is actually a plane in which the power law sits, and this is, this is the equation of a plane. It depends on two variables, P and A, that is X and Y, and then you have this surface that is hash rate, right? And in fact, it's not necessarily occupied by all of it, but it sits on a plane. But I think it's an interesting thing. And then actually, when you do that, the R square is even higher. They were coming close to 0.97. It improves actually, the correlation when you actually add more variables. So it's actually interesting because many times happen the contrary, right? When you actually add some other variables, you lose correlation, but in this case, actually it improves. Do you have any comment about this?
I'm not remembering what I did before because I did multivariate with price, with difficulty in addresses and age and so forth, and various combinations. But I can't remember what my results are right now off the top. But my two issues are this. One is that we had huge technology jumps early on in the hash rate production.
Yeah,
we went from CPU to GPU to ASIC. So we really jumped like a factor of 1,000 as we went from GPU to, or 10,000 as we went from GPU to ASIC. So I would only start with the ASIC era, which is 2013. So that's one concern. The other question is, when you go against addresses, you're ignoring the economic content of the addresses. And as you get into the modern times, it's more and more held by institutions where one address holds a lot of Bitcoin, but it's actually custodial for many, many economic agents, many, many shareholders, or many, many customers. And so you're hiding the true address count.
But then you can think about that big institution, like a big whale or something, right? But I mean, you can, like always, you can always break it down.
I think it may be the economic value, so that should be thought about.
Yeah, we can go deeper, etc. But I always like to start with the simplest possible model, without complications, and see what we can learn from it. And I like a couple of things. First of all, this idea that you go from one-dimensional thing, that is a line, to actually a two-dimensional structure, that is this plane. That is actually the power law. The power law goes through these two-dimensional structures, right? Because it's a line. It's still a line, but it's a line that lives in 3D. So it's kind of interesting because then you can write this equation that is, a 2D structure. So I want to see what else we can learn from this plane idea. And then I like the fact that actually the R square actually goes up, because there is some meaningful interaction between these three variables that improves actually the R square. But we could, improve it and study it better, and see, because it's a open question. In the book, I didn't go too much deeper in that because otherwise it has already 300 pages. This probably is something that we can explore in articles that we are going to publish and material that people can find in our website. The companion to the book to go deeper because there are these issue about the different epochs of hash rate. So maybe you need to adjust for that. Maybe there are different. Maybe the best model is different power laws. That have different slopes. I already did that with addresses because you can see there is a band in the addresses where two slopes will help. And maybe that is the presence of institutions that change the slope of the addresses. But we can explore because you can. This is why we will have a episode 1230 of the physics of Bitcoin, because Bitcoin gives you always way of going deeper and deeper. Anyway, so these are some of the actually figures that will appear in the book, to show how interesting and fascinating Bitcoin is, and it's a very interesting, fascinating topic to explore scientifically. Okay, so I think we covered a lot of interesting material. Let's look at some of the questions. We have a few of them. Some of questions are questions, some are comments. It's always time to DCA, and yes, you should chill because Bitcoin has a long-term trajectory, so that is good. The power law rules, exactly. I agree with the sentiment. I don't know. Apologies with the audio. I sounded good. Remember, we are in two different continents. I don't know where you are. Maybe there are problems like that. I am in the US. Stephen is in Thailand. Very nice compliment. Thank you so much. Okay. How do you take the variability of?
I don't. So you're talking about the return of capital. Basically their statement is that it's probably tax deferred for about a decade is what they're saying. Well, maybe it's 9 years if you're paying 11%. I'm not sure. But that's a tax issue. And so the people's effective return after taxes, at least in the next several years, is going to be higher than the stated yield that they receive, depending on what kind of accounts you're holding it in. But I'm just measuring it, I'm just using it effectively as an alternative asset in this 2-asset Kelly criterion. So that's really a secondary or a different consideration, and it's going to vary with everybody's own tax situation, what kind of account you have it in.
Yeah. Okay. This is what we are trying to do. In my particular case, I was a professor for several years and really missing the teaching aspects. And so I thank you guys to be like a class or whatever. That is, everybody has roles in life, right? But teaching, it's more like sharing of ideas and our exploration. But thank you. So there is a question. I think this is for you, Stephen.
Mm-hmm. Yes. I mean, this is a bubble or a wave, and it's going to be an uplift, and later it can be a downward and would be subtracted, just like we have historically. We've had bubbles and troughs. So there would be a trough phase in the future as the fundamental and the subharmonic, change their values with different frequencies, synchronized, but different frequencies. And so, as you get out into the 2030s, you would expect to see a trough. I haven't done all the detailed calculations on that, but it's kind of flattening out and heading into decline as you get into 2030. So it's going to be supportive, but less and less so for a few years after that. And I have tested against the timing of the troughs, and they also match this kind of fundamental lambda value of 2.07 for the spacing parameter.
Yeah, so my full PL model, the one, because actually the first bubble model that I have proposed was a log periodic one. I have actually timestamps to prove it. I mean, it was, it's not a big deal, but it's great, right? When Stephen improved it so much that he made it his own model. But I had this intuition myself. This is how you do science, right? Nobody invented quantum mechanics. There were a bunch of people that had intuition. Maybe, Planck was the first one introducing the idea, but he didn't even know what he was doing. I thought he was some kind of mathematical trick, introducing this quantum, and little by little, all the people contributed. This is how you do science, right? When you do it correctly, and you have the right motivation and so on. So, but at a certain point, I changed my mind, and I started to see some evidence that maybe the bubbles were periodic. There is some limitation in doing that. First of all, you have to throw away the first bubble. That is never a good idea to throw too much data. Sometimes you can do it. You could have made an argument it was a bubble that happened before the halving, whatever. You do this is how you do science. You try different things, right? You have different hypotheses, and then if a hypothesis doesn't hold, you have to go back to the drawing board and modify your models, update them, and this is how you do discoveries. This is how people made progress in every field of science. And this is a science. I know that is disappointing for people because they think we are, some kind of magicians or psychic. We are not psychic. We are trying to make sense of the data. And the beauty that Bitcoin has a lot of regularity, but sometimes, it's not what we are expecting. So we need to go back and changing our models and update them. Or maybe go back to the original idea that you discarded, So just update it, reflecting the learning of a time of a bubble. Do you understand what he's trying to say here?
Well, I guess. I mean, there are two possible questions here. One is that you had looked at this, back in the 2019 time frame, and actually, it's quite interesting that it would have, it supported the idea that there would not have been a bubble, your model, in 2025, and that there would be a next peak around right at the beginning of 2027, the very end of 2026. Now, I've got 6.5 more years of data that I've put in, and so things shift around a little bit, plus the phase component. So that pushes us out into 2027, 2028. So that's one whole thing. But I don't know if the other question here is your full model that you have on Discord that's been using linear cycles.
Right.
So, what you mentioned now is maybe we'll put up this model.
Yeah, exactly. So we will change it and update, or at least having both of them, and people can decide which one works best. Right. And then we have this question, and again, let me bring some. I think I know what we are talking about here, and again, sorry if I mention some personal things, because science is also made of people, right? So there is this researcher, but in general, I appreciate because he does a lot of good things. He has the right attitude, the right formula. He seems to know his stuff. But there are two issues. One is his name is Peterson, and you can find him online. I don't know if you know this guy, Stephen. He wrote a paper some time ago. He did actually the good thing of writing a paper when I didn't. We are in the process of doing that. I was posting my stuff on Reddit. It's still track record. It's still nowadays people even quote Reddit posts or social media posts when they do research. But I should have written a paper. But I was basically the first one that I know. I would like to know if anybody else can find another reference. But I was before him mentioning Metcalfe. I mentioned Metcalfe all the way to 2012. In fact, it was my first power law that I found. I have a Reddit post where I say, oh, I say that it was something in between Zipf and Metcalfe. I say it's kind of a generalized Metcalfe. I called it in that way. And I say, it's not quite two, it's close to two, but there is a very strong power law relationship between price and addresses, is what I say. He came later and he says something similar. But he never did what I didn't do at that time myself, found the next connection that was the addresses also on a power law. And then you close the loop. Okay. And he's coming, and now he's to save is whatever result he had. And I didn't go too deep, but I know already by intuition what he's doing. And it's so absurd. Okay. And he's doing it because he's so attached to this Metcalfe discovery, and he doesn't want to acknowledge that he was missing a point, because in my case, I acknowledge because I found the point. So I connect everything together and it works. But in this case, it will be to basically say, well, I came after Giovanni. I agree that he found also the other missing point. And he still has a role, he confirmed, he was on the right path. It's not competition. And he could continue to actually contribute to the power law. But he does these weird things to say that you should not look at the log of time, but the square of time. So now all of a sudden he sees a power law in price without using addresses or whatever. I can go a little bit deeper and try to understand what the heck is doing, but sometimes it's not even worth it. And, if you see that somebody's going in some crazy direction, you're just going to lose. You're going to lose time, if you do that. But why I don't like it? Log of time simply means why we do the log of time. It's not like any function works. Let's take the sine of time. Let's take whatever. The exponential of time. The reason why we take the log of time is because it gives us the scale. And scaling laws are everywhere in the universe. There is a logic, and there is a mechanism, motivation. There is physics-based intuition. The square of time, it means nothing. There is nothing. It's not a physical quantity. The log of time is, because it's a scale, like we just said before. The eyes, for example, respond to the log of time. The earthquakes respond to the square of the log of amplitude, right? The only thing that, for example, the square of energy, that is amplitude, right? You can take the square of a quantity, be a physical quantity, but the square of time means absolutely nothing. It's completely arbitrary, and it's an artifact. Is manipulating data in such way to basically save his model, and that is the thing that I hate. I completely hate when people do that, because it's confusing people. They are not able to distinguish between, he has this model, it seems to work. Look, it's a nice behavior, it looks like a straight line when you do that or whatever, but it has no physical meaning. It's an artifact, and instead log of time has a physical meaning. So that is my entire thing. So no, I didn't look at it, and I don't want to, because I don't see why. Why will you are not going to try all kind of combinations until something fits? You are going to do something that is motivated by physics, by mechanism. This is why we take the log of x of the log of y, because it's the natural way of showing the scaling behavior of a system. Do you have anything else to say on this? Or do you agree with my statement?
Well, the difference between statistics and numerology is that in physics, we're trying to answer the question why. We're always trying to get to the why, so we have to look at the what and the how. But the whole purpose of doing the what and the how is, statistics are tools for us so that we can eventually get at the why. And the why is that Bitcoin is a network that grows, that self-manages, that is autopoietic in nature, and that because of that, there's something called Lambert W. You start out exponentially, but because you've got feedback in this case, negative feedback control mechanisms through the difficulty adjustment, for example, as one of the most important, you convert some initial exponential growth into scale invariant growth, and in particular into power law growth. And we're trying to get at that kind of thing, that kind of understanding the why and the basic mechanism.
Right, because and people can use similar language. Like for example, he say, "Oh, Metcalfe apply to Bitcoin," but what he does, he says that Metcalfe applies directly between price and time. That means nothing because the Metcalfe law says that the value of a network, there is logic there, right? It says really what is the beauty of a network, the fact that it's more complex than just a gas. A gas has a bunch of entities, right? And they interact by collision, etc. So it's not, you can do a physics based on this interaction, but it's very boring interactions. And then you have networks that have communications and they process information, they transfer, the information can be transferred partially. They are much more complicated structures and it's still part of physics, but it opens an entire new universe of possibility because it's a much more complex system. And the idea is that this complexity, this connectivity is where the value of a network is. It's, in a way, you're saying that the whole is bigger than the sum of the parts. If I had one simple concept for networks, that is exactly what a network is. It's a system where the whole is much more important, much more interesting, much bigger than the sum of the parts. And he doesn't understand that. He thinks that it's just a formula where you relate one quantity to another. No, it should be the right concept. The concept is the links, and the links are basically the value of the network, and the nodes is not time because it doesn't mean anything to have time as nodes. Is the addresses, and this is why the Metcalfe law is between the price and the addresses. And the growth in time is a power law simply because many systems, and I have shown, I have also a graph yesterday posted. I'm posting a lot of graphs with this kind of style because it's what it will be shown in the book. And I superimpose, I don't know if you saw this graph too, I don't have it here in my slides, but it's in my X account, where I superimpose the power law for Bitcoin and the power law for the internet, and they are basically indistinguishable. And then there is this other thing called IMDb, that is a catalog of movies.
Amazing.
And that one also grows with the cube of time. And viruses, like, for example, AIDS grows with the cube of time, right? And you will think, where so you're saying Bitcoin is like AIDS. It's like a virus. It's a viral idea that is spreading with the population. And many times they do it like a power law. And for some reason, the cube, I don't know why the cube, I think will be really fascinating to find some way of proving the cube is the natural way for many. There is a reason. When the physicists see a pattern like that, see, that is not numerology, that is a signal. See, numerology is when people use number to say, oh, you see, there is this proportion between this thing and this other. It's all made up. There is not really any reasons why there should be this proportion of
well, in the case of the internet, in the case of Bitcoin, and in the case of viral spread, it's all due to human interactions and also the fact you have super spreader nodes. So some people have many more interactions,
right.
Whether on the phone or otherwise, and some people are better at promoting Bitcoin to many other people, etc. And then once you get organizations, like once you have a capital pool, like a hedge fund or something, then they are a super spreader to all of their investors, right? Correct. So it's the fact that you have these fat nodes that cause it to have that kind of characteristic power.
Yeah, there is this scholar called Barabasi that he came up with a theory. This is why I say it will be really cool to see why cube, if we ever find out a reason why cube versus other numbers. But in general, it shows that these phenomena that Stephen is describing, where there are hubs in the networks, creates power laws, gives to birth to a lot of power law properties of these networks. This is why networks and power laws go end to end. So, when we talk about these ideas, like always, right, it's all connected. It's not just a line that we feed through the data. There are all these other sides, these other angles, right? This is why, okay, yeah, sure, we should see power laws in Bitcoin because Bitcoin is a network, right? And it's all. I mean, we can mention so many things. Interaction between people going to conferences, people to listening to a video at 9 p.m. Or even later in other parts of the world, and about Bitcoin. Many people do that with other assets, right? This is why they behave different from Bitcoin, because we have a network, we have connections, we are listening to this information, we are interested. The way that price discovery is done in Bitcoin is very different than from these other assets. There is a human network, there is a machine network. Stephen called it a meta network. Exactly, it's a network of networks. So yeah. Anyway, guys, I think we cover a lot of material. And I think it has been a very interesting episode, and we will be here next week. Thank you to spend time with us and making the network stronger.
Thank you, everyone who hung in there. Thanks.
Bye, everybody.